In last class, we discussed about liquidity ratios in ratio analysis. Now we are going to learn solvency ratios. What is solvency? Solvency of a business means that business is in a position to meet its financial obligations as and when they become due. What is solvency ratio? Solvency ratios are the ratios which shows the organization's financial ability or the capability of the organization to meet its long-term financial obligation. That is solvency ratio. Once again, solvency ratio is to measure the organization's long-term financial liability repayment capacity. If a company wants the fund or extra fund for their business, for this purposes they issue debentures or they took a loan from bank or any other financial institution. At that time, the lenders, they analyzes the company's financial position, their debt repaying capacity. So that time they can use this solvency ratio. That means solvency ratio assess the long-term debt repaying capacity of the organization. Solvency ratios are mainly classified into four categories. That is, there are four types of solvency ratios. That is, debt to equity ratio, total assets to debt ratio, proprietary ratio, and interest coverage ratio. Let us discuss them in detail. First one, debt to equity ratio. From the name itself, we can clearly understand the relationship of this ratio, that is the debt, relationship between debt and equity. So the debt equity ratio means it is the relationship between long-term external equity and internal equity of the enterprise. What is external equity? External equity means long-term liabilities or other borrowed fund. That is the external equity. Then the internal equity. Internal equity also be a liability, but it's a internal one. That is the shareholders fund. That means debt equity ratio is the combination of borrowed fund or the outsider's liability and the shareholders fund. So for calculating the debt equity ratio, the formula is debt divided by equity. Debt means borrowed fund. Debt includes long-term borrowings and long-term provisions. And the equity means shareholders fund, that is the internal liability. Shareholders fund means share capital plus reserve and surpluses. Okay. Then in the case of debt, long-term borrowings. Can you say an example of this long-term borrowings? Long-term borrowings, the example is debentures, long-term bank loans, etc. Then the long-term provision. We know we create provisions for make the liability. That means that if we create any provision for the long liability or long-term purposes, that is the long-term provision. For example, provision for gratuity, leave encashment, etc. So the total of this long-term borrowings and the long-term provision is called the debt. Then the next one, equity. Equity includes share capital. Share capital means shareholders' contribution. That is the equity share capital or the preference share capital. Plus reserves and surpluses. Reserves, we know different types of reserve, capital reserve, general reserve, that type of different reserves we studied in the earlier. These reserve and surpluses, that is surpluses, balance in statement of P&L, that also be added to that value of equity. Surplus includes a balance in statement of P&L, that means whether it is a profit or loss. If it is a profit, that amount is added to share capital. If it is a loss, that amount is deducted from share capital. That is the formula of a debt equity ratio, that is debt divided by equity. That is the external fund divided by internal fund. The main objective of this debt equity ratio is to assess the proportion of external fund and the internal fund invested in the business. The ideal debt equity ratio is 2:1. A high debt equity ratio indicate that outsiders fund is more invested than that of the insiders. That means that shareholders fund. In that case, as lenders have more risk. That means their funds are not safe. Because debt to equity, that's a debt. If it is a higher ratio, means debt to value will increase. That means the outsiders liability will increase than that of the insiders or the shareholders fund. In the case of debt to equity ratio is low, that means the insiders or the shareholders fund is more invested in that company than that of the outsiders fund. In that case, as lenders fund are safe, they are in safe zone. They have no risk in the business. The main objective of a debt equity ratio is to assess the organization's financial soundness and the financial position of the organization. Then we are going to discuss a problem of a debt equity ratio. In this question, calculate a debt equity ratio from the following information. Total assets rupees 1,25,000. Total debts is 1 lakh and the current liability is rupees 50,000. That means current liabilities value included in total debts. In the accounting equation we studied total assets equals total liabilities. That means here the value of total assets is 1,25,000. Then what's the value of total liability? That also be a 1,25,000 rupees. So in this question, firstly we calculate actual external liability. The debt to value is rupees 1 lakh. But the current liability value is also be included in that external liabilities. So firstly we should calculate an actual value of a long-term external liability. So debt equals the total external liability value is 1 lakh. Then 1 lakh minus current liability 50,000 equals 50,000 is the actual external long-term liability. Actual external long-term liability is 50,000. Debt equals actual external debt 1 lakh minus current liability 50,000. Then the 50,000 is the actual external long-term liability. Then next one we should calculate equity. For this we know total asset equals total liability. So the total value of liability is 1,25,000. So equity equals total liability value is 1,25,000 minus other external debt. Other external debt is rupees 1 lakh. What's the value? 25,000 is the value of equity. Then for calculating debt to equity ratio, debt to equity ratio equals debt divided by equity. That means here the value of debt is 50,000. Then value of equity equals 25,000 equals 2:1. This 2:1 is the ideal proportion of a debt to equity ratio. Here the debt to value 1 lakh rupees, total external debt is rupees 1 lakh and the current liability, that means current liability value is included in the total debt to value. So we should calculate the long-term debt. For calculating the long-term debt, just deduct the current liability from total value. Then the value of debt, that means the long-term debt is 50,000. Then the next step is to calculate the equity. In the case of equity, we know the formula total asset equals total liability. So the total assets value directly given in the question, that is rupees 1,25,000. The same value is the total liability. So equity equals this total liability value minus external debt. Total liability value 1,25,000 minus the external total external debt is rupees 1 lakh. Then the remaining amount, that is the 25,000, is the equity value. Then debt to equity ratio equals debt divided by equity. 50,000 divided by 25,000, it is the 2:1. Then the next question, that is calculate debt equity ratio from the following information. Here the fixed assets value given, that is gross, let's say gross value, not the net value, rupees 6 lakhs. Accumulated depreciation rupees 1 lakh. Then non-current investments rupees 30,000. Long-term loans and advances rupees 20,000. Then current assets value 2,50,000. Current liability 2 lakhs. Long-term borrowings, that's a 10% debentures. That means company have the long-term borrowings, total long-term borrowings is rupees 3 lakhs. That's in the form of debentures. So then the next one is long-term provisions rupees 1 lakh. Calculate debt equity ratio. Okay. From this we can easily calculate the value of debt, because long-term borrowings and the long-term provisions value directly given. So just take the total of this long-term borrowings and the long-term provision. 3 lakhs plus 1 lakh, 4 lakhs is the value of debt. But in the case of equity, we should calculate it. That's not directly given. From this information, you firstly calculate total value of asset. This total value of asset, take the total of fixed asset and the current asset. From this, fixed assets value, let's say gross value, and then the next one is accumulated depreciation. Firstly, you should calculate the net value of that fixed asset. What's the net value? 6 lakhs minus this depreciation 1 lakh. 5 lakhs is the actual value of a fixed asset. Then for calculating the total asset, fixed assets plus non-current investments plus current assets and the long-term loans and advances, because long-term loans and advances is not a part of a liability, because the long-term borrowings is directly given. So the long-term loans and advances are part of a asset. Firstly, calculate debt. Debt equals long-term borrowings plus long-term provision. Then long-term borrowings is, what's the value of long-term borrowings? 3 lakhs plus long-term provision. Long-term provision value is 1 lakh. That equals debt value is 4 lakhs. Then the next one is to calculate equity. For this, firstly you calculate total value of a asset. Total asset equals fixed assets plus non-current investments plus current assets and loans and advances. In this case, fixed assets, we take only the net value. Net value means 6 lakhs minus depreciation 1 lakh. That is the net value of fixed asset. Plus non-current investment. Non-current investment value rupees 30,000 plus current asset. Current assets value is 2,50,000 plus loans and advances. Loans and advances value is 20,000. What's the total value? 8 lakh rupees is the value. Okay, total assets equal 8 lakhs. Then calculate equity. Equity equals total liability minus current liability and non-current liability. So total liability is 8 lakhs minus current liability value is given in the question rupees 2 lakhs. And the non-current liability we calculated rupees 4 lakhs. The value of equity equals 2 lakh rupees. So the value of debt is 4 lakh and the equity value is 2 lakhs. Then debt equity ratio equals debt to equity ratio equals debt divided by equity. Debt equals our 4 lakhs rupees. The value is 4 lakh rupees and the equity value is 2 lakh rupees. That equals 2:1. That is the proportion. Then we are going to discuss about the next ratio, that is the total assets to debt ratio. Total assets to debt ratio is the relationship between total assets and debt. This shows the financial position and the soundness of the organization. It compares the total value of assets and total external debt of the organization. Total assets includes all the assets of the organization, that is the fixed asset, all the intangible fixed assets and the current assets. It will be compared to the total external debt, that is the long-term borrowings and long-term provisions. The formula for calculating the total assets to debt ratio is total assets divided by debt. Total assets includes all assets, that is all the non-current and current assets. And the debt includes only long-term borrowings and long-term provisions. The main objective of this total assets to debt ratio is to measure the extent to which the assets is covered the debt of the organization. In this case, the higher ratio indicates that because the assets value is more than that of the debt value. So the lenders are in the safe zone, or their funds are in the safe position. If the total assets to debt ratio is lower, that means the debt or the borrowed fund is more than that of the total asset or the investment of the company. In that cases, the lenders, their funds are not in safe position. They have more risk. The ideal ratio of total assets to debt ratio is 1:1. Then we are going to discuss a problem. In this case, shareholders' fund is rupees 14 lakhs, total debts is 18 lakhs, current liability is 2 lakh. Calculate total assets to debt ratio. In this case, shareholders' fund is given and total debt is given and also current liabilities. So, firstly you calculate the total value of asset. For calculating the total value of asset, just take the total of these liabilities, because total of assets are equal to the total of liabilities. So, the total liability equals shareholders' fund plus total debt, that is the liabilities. That is the 14 lakhs plus 18 lakhs. That equals 32 lakhs. Then total assets to debt ratio equals this 32 debt total assets divided by debt. Total assets value is 32 lakhs divided by debt value. Total debt liabilities rupees 18 lakhs. In this 18 lakhs, current liability value is included. That means actual long-term debt is 18 lakhs minus this 2 lakhs, 16 lakhs equals 2:1. In the case of debt, 18 lakhs is the long-term, is the total debts. It includes the current liability value. So for calculating the long-term debts, just deduct the 2 lakhs from this 18 lakhs. The value is 16 lakhs. 32 lakhs divided by 16 lakhs equals 2:1. This is an activity for your homework for you. Compute total assets to debt ratio and the debt equity ratio from the following information. From this information, you should calculate two ratios, that is a total asset to debt ratio and also debt equity ratio. The information is given. From this, you can easily calculate these two ratios. Do it by yourselves. To be concluded, today we discussed about solvency ratios, that is the total assets to debt ratio and debt equity ratio.